Energy and crude are a political hand grenade for nearly every country, this according to our next guest. OPEC's relationship with the U.S. and the U.S.'s use of the Strategic Petroleum Reserve is just one of several flashpoints worldwide. With more, we've got Rebecca Babin, who is the senior energy trader over at CIBC Private Wealth U.S. All right, help us break this down a little bit more. When you say political hand grenade, what should we expect to play out with regard to this?
So that's a great question. I think what we should expect to play out is a lot of volatility going forward, right? We're looking at an escalation of the relationship between OPEC and the U.S. and both parties trying to influence how crude trades, one by cutting production and supporting prices, and the other by releasing barrels of the SPR into the market, right? So you have these dueling factions, both trying to sway market pricing. This is a big deal because this is a market that traditionally trades on fundamentals, supply and demand. And now you have these two huge players kind of at the other ends of the poles trying to influence the market. So that's one thing to expect. I expect that we will see more SPR releases come throughout the winter. Last week's announcement from Biden really was a reiteration of what he's already deployed, which was 180 million barrels in May. He said he's going to do the last 15 million barrels over the next month. There is room, however, for him to do more as we head into 2023, and I do expect that. On the other side of that equation, I think we have OPEC Plus, which is going to continue to cut production and make sure that the market does not feel a lot of downward pressure. Why are they going to do this? Because the macro environment is super challenging right now with cross currents, Chinese demand as a huge concern, European recession as a huge concern, and they really want to support prices in the near term and not let the bottom fall out of crude as it has done in previous cycles.
Then Rebecca, given those you have OPEC Plus cutting, you have the Biden administration putting more oil out there on the market, what does that mean for prices?
It's a great question. And a lot of that hinges on what happens as we head into the December 5th EU sanctions package and how much Russian crude is disrupted based on those sanctions. So I personally think the market is anticipating about 1 million barrels of Russian crude to be disrupted due to the increased sanctions. And that ultimately the floor under crude is strong enough to hold, but the upside is a little bit more of the unknown. If we lose 1 million barrels of Russian crude and China demand starts to improve, and I know the data we saw today wasn't really indicative of that, but if it does, you could see a lot more upside. So I think ultimately you have downside kind of to that 70 to 75 range, and you have upside north of 100. So if you're looking at risk reward, it really feels like at this point we're fairly well balanced, but the upside tail looks a little bit more explosive. However, there are very few investors willing to put that money to work. If we look at positioning that came out over last week, we saw continued cutting of WTI, Brent, and gasoline products positioning as the market is really afraid of all of these risks and not really feeling comfortable making a bet either way. So I think that's what increases the volatility is there's a lack of positioning and these really outside tails on either end of the spectrum here.
Does China still want to be a purchaser of Russian oil supply?
I think they do. So I think that it makes a lot of sense for them. And if we just look at their most recent actions, they're increasing their imports of crude, even though their demand for crude isn't increasing. Why? Because they increase their quota for export of product. So they're buying cheaper crude from Russia, they're increasing their refining capacity, and they're selling that really expensive product out to the market. As we have all talked about, refining margins have been really, really robust, and they're able to turn that profit. It makes sense for them on a multitude of levels. It helps spark internal demand and keep the economy going a little bit. It fills a hole of the product supply that could be disrupted from Russia, and they're able to turn a profit. So I do think they're going to continue to want Russian crude. I don't think they're going to be super public about it, but I think they'll continue to buy it.
Rebecca, we've seen some reports recently that looking at the heating oil market this winter, you as consumers, they might see their bills go up anywhere from 20 to 30%. Does that sound about right to you?
Yeah, it does. And it's unfortunate, but the reality is our heating oil inventories are very low. I mean, the lowest I think that they've ever been. Does it mean that we're going to have, run out of inventories? No, it means that we're going to have the potential for spikes, particularly in a cold winter. And I think it's drawing a lot of concern. And that's why we're seeing China really ramp up their diesel exports because those refining margins are so high for diesel. The U.S. is in this situation because we've cut a lot of our refining capacity. So even though we have a lot of crude coming out of the ground, we don't necessarily have the refiners there to produce it into product to help, kind of meet these needs. So unfortunately, 20 to 25%, I think is kind of where prices are looking. If we get a mild winter, that could come in. But it's really kind of a weather dependent scenario. And I think there's a lot of fear baked into that as well.
Rebecca, I'm going to ask a question that is absolutely fueled by my own personal aspirations of seeing lower airline prices in the future and where in this environment they're purchasing from the different suppliers and refineries and particularly where that will actually net out for them to see lower fuel costs. We saw it show up in American Airlines earnings that they were paying 97% higher for some of their supply. And so when will that start to subside for the airlines and their purchasing requirements that they need just to operate their routes?
I don't think that subsides in the next 6 months or even maybe the next year, unfortunately, unless, and this will be the sad scenario, we have more restrictive travel policies globally due to COVID. But based on where things are right now, if the demand stays where it's at, and I kind of feel like it might, you don't really see that pullback in jet because, again, you need someone to refine all that crude into jet fuel. And right now, it's more attractive to refine it into diesel because that has the higher refining margin. So you're going to use all your refinery capacity to diesel, and then you'll do jet, right? Until the price of jet becomes so expensive that people reconfigure the refiners to sell jet. So the sad answer is probably not for a little while. You might see a modest dip, but I don't think you go back to kind of really, really attractive pricing for at least a year.
Rebecca, I just purchased 5 new blankets from Target because I'm not hitting my thermostat this winter. Not touching it. It might be 60 degrees in my place, just not going near it. Rebecca Babin, senior energy trader at CIBC Private Wealth. Always good to see you. Talk to you soon.